Good afternoon and welcome to the lecture 8 of ETC 779. In previous lectures, we discussed some of the interest factor formulas and the application of cash flows were discussed. If you remember, I had pointed out that cash flows are very useful as far as computation of the cash requirement is concerned, the computation of capital lockup is concerned, and the third one was for finding the equivalence. Now, while discussing the equivalence, I had given you one small problem in which I had told you to work out some of the factors such as present worth factor, future worth factor and so on. So, in this particular class what I am going to tell you is to start working with that problem initially, and then we move on to different alternative comparison methodologies. We will be discussing present worth computations in this particular lecture. So, I will tell you all those scenarios in which you can compute present worth. There are essentially three types of situations you will be encountering while evaluating two alternatives for a given situation. The alternatives could be of equal lives, that is case number 1, alternatives with equal lives. Case number 2 would be alternatives with different lives, and finally we will see the third case which deals with the situation in which alternatives have infinite lives. So, these three aspects I will try to cover up in today's lecture. Case 1 would be dealing with the situation in which the given alternatives have equal lives. So, we call them by equal lives cases. Second one would be unequal lives, and third one infinite lives. So, as I told you just at the beginning of this lecture, I will once again proceed with a small problem and try to brush up all the interest factor formulas that we have seen in previous lectures. For example, this is a very simple sum in which you are given rupees 50,000, let us say at time t is equal to 0, right. You are given 50,000 at time t is equal to 0. So, if I draw it in a cash flow diagram, let us say rupees 50,000 at time t is equal to 0. I am interested in finding its present worth here, future worth at n is equal to 10 years. Now, that means interested in finding future worth f. So, I am writing f is equal to what given n is equal to 10 years. Now, you can assume an interest rate I is equal to 10%. Now, there are two ways in which you can solve this problem. First one is by use of formulas, interest factor formulas which I gave you in last class, and second one you can refer to the interest factors given in the textbook. Let us assume that you are interested in using the interest factor formulas. So, what I am interested basically in finding f for a given value of p, that means f given p for an interest rate of 10% for 10 years. This is what I am interested in finding, f given p for an interest rate of 10% for a period of 10 years. So, what is the formula that is given to you? It is 1 plus I raised to power n. This is the formula for finding the interest factor. Now, I is 10%, so that I convert it in decimal. So, 1 plus 0.10 raised to power 10. So, if you calculate, this value is going to be 2.594. What does this interest factor means? This means that rupees 1 now, rupee 1 now is equivalent to 2.594 rupees at the end of year 10 at an interest rate of 10%. Clear? And this is what is also known as single payment compound amount factor. Single payment SP compound amount factor. This formula I have used because I have only single value of disbursement. Disbursement, why? Because it is shown in negative. That means this 50,000 is going out of my pocket. Clear technology class? Okay. Now, the same formula, same problem, I just reverse it. That means now somebody is giving me rupees 50,000 at the end of year 10, and I am interested in finding its present value P at time t is equal to 0. Here again I have got two options. I can use the formula directly, or I can refer to the table corresponding to I is equal to 10%. If you refer to the formula, it is just the reverse. That means we are interested in finding P and we are given F. So, we are to write P given F at an interest rate of 10% for 10 years, which would be given by 1 upon 1 plus 0.10 raised to power 10. Just the opposite of the previous formula, and this is nothing but 0.3855. This factor you can check it from the interest factor tables. So, what is the meaning of this factor? 1 rupee at the end of year 10 is equivalent to 0.3855 rupee now. So, how much 50,000 rupee at the end of year 10 would be equivalent at t is equal to 0? It would be nothing but 50,000 multiplied by 0.3855. Now, on the same question, I will just do some more manipulations and come up with another thing. Now, let us say the situation is like this. I have 50,000 rupees going out of my pocket at t is equal to 0. I am interested in finding how much this is equivalent to for a fixed sum payable at equal interval, that is on an annual basis for 10 years. That means I am interested in finding A is equal to what? Here again I assume I is equal to 10%. So, which factor should I use? P is known to me. I will be using A given P for an interest rate of 10% for a period 10, and here again I have two options. Either I use the interest factor table given in the textbook, or I use the formula which has already been told to you. Now, if you see the table, you will find a value of 0.1627. This factor 0.1627 means that if I am paying rupee 1 at time t is equal to 0, it is as good as paying 0.1627 rupee every year from now onwards up to year 10. So, you can see same problem you can twist in numerous of ways. The problem I have chosen just to illustrate you the application of interest factor formulas as well as interest factor tables. Now, I will also illustrate you how to use geometric gradient factor. In this case, let us say rupees 1000 is received by me every year for the next 5 years, year 1, 2, 3, 4 and 5. In addition to this, I am getting an increment of 200 rupees every year like this. That means first year I am getting 1000, second year I am getting 1200, third year I am getting 1400, fourth year I am getting 1600, and finally fifth year I am getting 1800. So, this is a problem in which the cash flows are increasing in an arithmetic gradient manner. That means every year it is increasing by 200 rupee. So, you can find first year it is 1000, this is time t is equal to 0, second year it is 1200, third year 1400, fifth year it is 1800. Now what we can do is, using the interest formula that I have given you, you can convert this portion which is shown in hatched line. This triangular portion I can convert it in a uniform series payment by using the formula. What formula I will be using? A given G for an interest rate of 10%. Now here the number of periods are 5. So I will use 5 here. So this formula A given G 10% for 5 years is going to convert the triangular hatched portion alone into a series like this. Some value here, some value here, some value here, some value here, and finally some value at the end of year 5. So here you have 1, 2, 3, 4 and 5. So what essentially this formula is doing? This is converting the increase or decrease portion alone into a uniform pattern. Now suppose you are able to get X amount here, here, here using the formula. You can find out this. Then the final cash flow diagram for this triangular as well as for this rectangular block would be given by 1000 plus X, 1000 plus 1200, 1000 plus X, 1000 plus X, 1000 plus X, because this uniform portion is 1000. So here you have 1000, 1000, 1000 and 1000. So that is already uniform, and X is nothing but the uniform series for the triangular portion. So the resultant cash flow diagram would be like this. This would be 1000 plus X. This again would be 1000 plus X. 1000 plus X, so on for year 5. So 1, 2, 3, 4 and 5. So what we have done is, we have converted the arithmetic series cash flow into a uniform series cash flow. Now it will be very easy for me to use my computations from here onwards. Is it clear, technology class? Fine. So this is as far as a brief review of all the interest formulas, interest factors that we discussed in yesterday's lecture. Due to paucity of time, we couldn't take up this exercise, and that's why I thought of completing this right at the beginning of this lecture. Now we are going to move to equivalence. Now when we talk of equivalence, it is like comparing equal thing with, it is like comparing apple with apple, unlike comparing apple with orange, let us say. So what we do in this is, we understand, rather we realize that until and unless money is at the same point of time, we can't add or subtract them algebraically. So, this is the basic philosophy of equivalence. It will be more clear if you look at this example. Suppose I have 1000 rupees at time t is equal to 0 and I am getting rupees 1000 again at time t is equal to 1. Let us say after 1 year. Suppose I am interested in finding how much money I am getting at the end of year 1 or how much money I am getting at the end of time t is equal to 0. So, you can realize that it is not possible to add them simply algebraically, because this 1000 rupees at time t is equal to 0 is not the same as this rupees 1000 which I am receiving at time t is equal to 1 year. Now, suppose I have to add them, what do I do? Either there are two ways of doing this. Either I bring this 1000 at this point of time and add them here with this figure, or I can move this 1000 at this point of time t is equal to 0 and then add them. Now, this is what is called this is the way we will proceed as far as all our computations are concerned. We will realize that money has got time value. So, some receipt which I am receiving at time t is equal to 0 is not the same which I am getting at time t is equal to 1. So, in order to do some computations, the first thing that I have to ensure is they must be brought at equal footing or at the same point of time. Until unless they are at the same point of time, we simply can't add them. So, for this example, either I have to convert this 1000 to its future value f at time t is equal to 1 and then simply add 1000 into it. Suppose interest rate is 10%, this 1000 would be equal to how much at time t is equal to 1? It would be 1 plus 0.1 raised to power 1, which would be 1.1 into 1000, that is equal to 1100. So, that means this 1000 rupees at time t is equal to 0 has a value of rupees 1100 at time t is equal to 1. Clear? Now, once I have got this 1100 at this point and 1000 rupees at the same point, I can add them. So, the net value of these two receipts is rupees 2100 at the end of year 1. Now, it is possible to add them algebraically. Why? Because both are at the same point of time. Now, 1000 rupees which I have received at time t is equal to 0 has a value of rupees 1100 at time t is equal to 1. At that point of time itself, I am receiving another rupees 1000. So, the total I am getting is rupees 1100 plus rupees 1000, that is equal to rupees 2100 at the end of year 1. Now, same thing could have been converted at time t is equal to 0. That means, in this case what you can find is rupees 1000 which you are getting at the end of year 1, you bring it to time t is equal to 0. 1000 rupees which you are receiving at time t is equal to 1, please bring it to time t is equal to 0. You will find that it is equivalent to rupees 1000 divided by 1.1. Now this time, now both the transactions are happening at time t is equal to 0. If you see the same example other way round, it will be something like this. 1000 rupees, let us say this is end of year 0, end of year 1. In this case I have rupees 1000. In second case I have rupees 1000, right, at time t is equal to 1. Now in this case I am trying to bring this 1000 at this point of time, at time t is equal to 0. So this becomes f for me, future value. I am interested in finding its p. So it would be equivalent to 1000 divided by 1 plus 0.1 raised to power 1. That means this 1000 is equivalent to 1000 divided by 1.1. Now this value as well as this 1000 rupees are at time t is equal to 0, both at same point. So now it is not at all difficult to add them algebraically. Clear? Okay. Now we move on to the equivalence concept further, and there you will find that we have a number of methodologies available before us to take a appropriate decision as far as the most economical alternative is concerned. If you remember the first few lectures, I had emphasized the role of engineer as someone who is coming up with different alternatives to do a particular work, to do a particular activity. Now these alternatives are thought of in terms of its economics, and now once you have got different alternatives before you, the current lecture will help you what methods to choose, or rather what are the methods available through which we evaluate these alternatives. So there are different ways of evaluating alternatives as far as economics is concerned, economy is concerned. The first and most common you will find is the present worth comparison. If you look at this slide, it shows present worth comparison. Please look at the slides. Then you have future worth comparison, annual cost or annual worth method, rate of return method, and finally prospective value method. These are some of the ways in which we evaluate different alternatives. Now in this particular lecture we are going to discuss in detail the computations involved in present worth comparison. That is the first aspect as far as evaluating alternatives are concerned will be discussed in this particular lecture. Now before going into the details of present worth comparison, we would like to discuss some of the assumptions which are there when we simplify our computations. You will find that it is very difficult to convert a real life situation in some mathematical form. Now, in order to make it slightly simpler so that users can use it, some of the basic assumptions are made. Remember, these assumptions are just to help our computations in an easy manner, so that we can perform all the calculations a bit faster. So, the first assumption is that cash flows are known. This is the very basic assumption we are making as far as our discussion on cash flows are concerned. You will find that any decision that we are going to take will depend on the cash flow diagrams. So, what is the inherent assumption? Inherent assumption here is that we have been thorough in our estimation, and whatever estimate of cash flows we have made is truly known. There could be situations in which so many things are uncertain, especially at the beginning of the project. Specifications may not have been frozen, client may not be aware of the final outcome that he is wanting, drawings may not be available, sometimes the vendors' rates would vary. So, there are many unknown situations which bring about inaccuracies in your estimates or your cash flow projections. You might have thought of a vendor giving you a credit period of 1 month, whereas when you start the work you may not get a credit period of 1 month. So, all these things will have a tendency to make your cash flows inaccurate or uncertain. There are different ways in which these uncertainties are taken into account. Right now, we are not going to discuss those aspects. We will discuss it when we take risk analysis in one of the lectures. But till the time we go to that risk analysis part, you assume that whatever cash flows are given is the known value to us. There won't be any change as far as cash flow values are concerned. So, it is not that you have anticipated rupees 1000 receipt at time t is equal to 0 and it becomes rupees 500. No, we are not dealing with such situations. We are dealing with those situations only in which we are pretty confident about our cash flow projections, pretty much confident about our cash flow projections. The second assumption is cash flows do not include effect of inflation. This part, whatever problems we will be taking in very immediate lectures, you will find that we are not catering to the effect of inflation. So, basically we are assuming that there is no inflation in the market. Although this assumption is not accurate, but for our problem solving, we will assume that our market is free of inflation. We will discuss in some of the classes how to take into account the effect of inflation. So, right now you can understand that we are dealing with situation in which constant rupees or constant dollar is involved. So, all our analysis which we are going to see shortly is based on the assumption that there is no inflation. Then the third assumption is that interest rate is also known. Now, you will find that it is a common knowledge basically that interest rates also keep on varying. Even for a short duration, you will find that there is a change in interest rates. Now, if you see our problems, especially in construction economics, the duration of the alternative would be very high, maybe 2 years, 3 years, 4 years, 5 years. Now, interest rates are bound to change in such a long period. But in spite of this, we assume that the interest rate is known and is not going to change for the given duration of the project. This aspect in which the interest rates go on varying will be covered in some subsequent lectures, in which we will assume that okay, interest rate could vary from this percentage to this percentage, and then how to take care of those situations. I will take it up in some other lecture. The fourth point is comparisons are made with before tax cash flows. This point you please make a note of, it. We are dealing right now with pre-tax cash flows. That means we are not considering any tax impact into our computations. This is also not practical, because if some company is involved in business and if they are earning profit, they have to pay the taxes. So, in some of the lectures I will demonstrate you the effect of taxes as well as the effect of depreciation on the cash flow diagrams. The cash flow diagrams in which you take into consideration the depreciation and tax part are known as post tax cash flow diagram. So, in real life situation you will be dealing with post tax cash flow analysis, whereas in immediate classes you will be dealing with situations in which no tax consideration is there. Now, if you see the second last point, it says comparisons do not include intangible considerations. There are no ways through which we can take into consideration these intangible benefits. Sometimes you will find that a project, even though its benefit cost ratio is coming to be less, or even if its NPV is coming to be less, it may generate lot of goodwill to from the local residents. But how to take into consideration those intangible benefits is very difficult, and that is why our analysis will exclude all those considerations which we cannot convert it in monetary terms. If you find that you are able to convert something into money part, fine, you take it, but there are still many things which you can't compare or which you can't judge it or monitor it through money alone. So, those things we will not be taking it into our analysis. And finally, the comparisons which we will be doing shortly, they do not include consideration of the availability of funds. It may so happen that while comparing alternative, you find that there is an alternative for which the initial investment requirement is very high, but if you compare its lifelong cost analysis, they are found to be cheaper. So, this analysis assumes that you do not have fund constraint, you do not have the constraint of money. These are some of the assumptions which we will be using it for our analysis purpose. Now, I will tell you the different cases that you may encounter while doing the present worth problems. Now, there could be three types of situations when you deal with present worth problems. Type 1 problem would be involving those alternatives with equal lives. When I talk of equal lives, the statement of problem could be like this: there are two brands of equipment, brand A and brand B. Now, both the brands have got same service life. When you have a statement like this, it means it is a type 1 problem. Why? Because both the alternatives in this particular problem, brand A and brand B, are having equal service lives. So, the moment you find equal service lives or equal time period, you can adopt this approach to solve problems. Now, in type 2, you will find alternatives with unequal lives. The statement of problem could be something like this: brand A of equipment, the manufacturer claims that it will last for 7 years, whereas brand B produced by manufacturer B, let us say, has a service life of 10 years. So, what you find? Alternative A has got different life, alternative B has got different lives. Now, this is a very tricky situation. Now, there are number of ways through which we can tackle this class of problems. However, for our class, we will consider only two approaches. One is called common multiple method, second one is called study period method. We will discuss these two methods and their illustration would be given to you by means of a few examples. Now, when I move to type 3, they are basically the problems which involve infinite lives. Now, most of the civil engineering structures, you will find that they have a very high life of the order of 75 years, 100 years, 150 years. For all practical purposes, they can be treated as structures or alternatives with infinite lives. If you notice the interest table which is given in most of the textbooks, you will find that when the value of n goes beyond certain point, let us say beyond 50 or beyond 60, you will find that there is not drastic change in the values. So, today what you can see, you can look down the interest factors very closely, especially for a period more than, let us say, n is equal to 30. You try and observe the differences, observe the increase, observe the decrease in those interest factors. So, for this class of problem, we have a very simplified approach which is called capitalized equivalent method. So, these three type of problems, first with equal lives, second with unequal lives, and third with infinite lives, I will illustrate you through a simple example. Now, when it comes to alternatives with equal lives, it means that the competing alternatives, which are competing alternatives? The alternatives out of which you have to choose one. Let us say you have got two alternatives A and B. For both these alternatives, the lives are equal. So, what we do? in order to use this method, we calculate the present worth of both the alternatives. So, step 1 is find the present worth of both the alternatives. And how do you take the decision? The decision rule is the alternative with the maximum present worth, the alternative with the maximum present worth is the most economical alternative. Now, there could be further complications here also. There could be situation in which you are given cost related information alone, and those type of cash flow diagram, if you remember, we had given a name cost dominated cash flow diagrams. So, if it is a cost dominated cash flow diagram, the decision rule is the alternative with the lowest present cost is the right alternative. Whereas, when we are dealing with present worth situation in which we are given the revenues alone, at that point of time we calculate the present worth, and then the alternative with the maximum present worth is the most economical alternative. Now, in case of mixed type of cash flow diagram in which you are having cost information as well as revenue related information, in such cases what we find? We find the net present value, NPV, or sometimes it is also known as NPW, net present worth. These are nothing but the differences of present worth of revenues and present worth of costs. So, if I take the difference of these two values, what are these two values? Present worth of revenues minus present worth of cost. This I call NPV or NPW, net present value or net present worth. Now, this has been shown in one example. I will tell you how to do the computation. So, for that, just take this example. The problem is, compare an alternative A costing rupees 5 lakhs, that means rupees 500,000, and requiring cash outlays of rupees 250,000 a year for 10 years, with B costing rupees 7,50,000 or rupees 750,000 and requiring prospective cash outlays of rupees 200,000 a year for next 10 years. Now, you are to suggest which alternative you would choose if interest rate is 10%. So, problem is clear to you. It says there are two alternatives, alternative A and alternative B. Alternative A is costing rupees 500,000 right at time t is equal to 0, and it further requires rupees 250,000 every year for next 10 years. So, if you see, if I try to develop the cash flow diagram for this, it looks something like this. For brand A or alternative A, it says that you have to invest rupees 500,000 at time t is equal to 0, and every year rupees 250,000. So, at time t is equal to 1, 2, 3, so on. This is, let us say, time 10, t is equal to 10. Now, every year I have to pay rupees 250,000 per year. So, this is the cash flow diagram of alternative A. What about the cash flow diagram of alternative B? How it would look like? It will be something like this. Rupees 7,50,000 or 750,000 at time t is equal to 0, and every year an expense of 200,000. So, this is 200,000 every year. So, this is as far as alternative 2 is concerned or alternative B is concerned. So, what you find that the initial investment required for alternative A is rupees 500,000, whereas for alternative B it is very high, rupees 750,000. So, where is the benefit of going to this higher investment? You are getting a saving in annual expenses. In first case, that is for alternative A, you are getting an annual expense of rupees 200,000, sorry, rupees 250,000, whereas for alternative B, you are getting an annual expense of rupees 200,000 only. So, what is happening? Initially, you had made an extra investment of 7,50,000 minus 5 lakhs, that means 750,000 minus 500,000. So, you have made an extra investment of rupees 250,000 and you are getting a benefit of rupees 50,000 every year. So, if you look it at other way round, you have to invest a larger amount for alternative B, but you have to spend lesser amount towards its operation and maintenance. Now, suppose this is the problem given to you and you are told to find the most optimum solution or the most economical solution, how to proceed. There could be number of ways to solve this problem, but since today's lecture's focus is on present worth computation, we will illustrate this problem solution using present worth method. So, if you look at this slide, this is nothing but the cash flow diagram for alternative A and alternative B. That is what was shown to you on the piece of paper. Now, in order to find the present worth or rather present cost, because if you see the cash flow diagram, you will notice that this is a cost dominated cash flow diagram. Nowhere for the two alternatives I have discussed about the revenue or the money that it generates. All the data for both the alternatives say that this is the expense, this is the investment. I have no information for both these alternatives that how much money they are bringing in. So, you can notice that both these cash flow diagrams are cost dominated. So, what is the decision rule for cost dominated? Rather, what are the steps? Step 1 is calculate the present cost for both the alternatives, and whichever cost is lowest, go for that option. So, let us try to calculate the present cost for both these alternatives. Now, in this particular slide, you can find the calculation of present worth, right. You can call this as present cost of alternative A also, right. These words people use interchangeably. So, let us not go into the discussion on whether it should be present cost or present worth, but just try to understand the principle how to calculate the present worth or present cost. So, what we do for this is, if you look at this particular slide, this 50,000, 500,000 is at time t is equal to 0. Now, if I convert all these values, that is rupees 250,000 per year for next 10 years at time t is equal to 0, I will simply add this 500,000 with the equivalent present worth of rupees 250,000 per year for next 10 years. So, what essentially I am interested in is to convert these values at time t is equal to 0. That means, I am interested in finding P is equal to what for an annuity. Why annuity? Because the amount is same, A rupees 250,000 every year. So, this amount I am interested in finding its equivalent present value. So, what factor I will be using? That will be decided by what is known to me and what I am interested in finding. So, I am given A is known, I am interested in finding P. So, P is what? So, which factor I will be using? P given A at an interest rate, let us say 10% for let us say a period of 10 years. So, I am interested in finding the value for P given A for an interest factor of 10% for n is equal to 10 years. If you look at the interest table, this value comes to 6.1446. This value you can calculate it either using the interest factor formulas or using the table. You will get a value of 6.1446. So, if I multiply this value with rupees 250,000 and add rupees 500,000, I will get the present worth or present cost of alternative A. So, it becomes present cost or worth, whatever you say, would be 500,000 plus 250,000 multiplied by 6.1446. This is nothing but present cost of alternative A. What I have done? I have converted an annuity of rupees 250,000 to time t is equal to 0. Now, at time t is equal to 0, I already have a value of 500,000. So, the total present cost or total present worth of this alternative A becomes 500,000 plus 250,000 multiplied by 6.1446, and this is nothing but, if you do the calculations, it would be 2036150. Now, one more thing at this point of time I would like you to take note of. I could have done this calculation assuming all these values as negative, because they are money which is going out of my pocket. So, I could have very well taken this as minus. So, the resultant would have been minus also. So, it does not matter what sign convention you use, please use them consistently. So, if you are using positive for receipt in some example, in the same example for other alternative also, you should take that positive as receipts. So, like this you can calculate the present cost of alternative B also. Same way, alternative B, you have rupees 200,000 annual expenses for next 10 years. So, here also the interest factor would remain same, which would be equal to 6.1446. When you multiply it with rupees 200,000 and add 750,000, you will get a figure of 1978920. That means it is 19,78,920. Now, out of these two options, you find that the cost of alternative B is the lowest. For alternative A, the cost is rupees 20 lakhs something, whereas the cost of alternative B is rupees 19 lakhs something. So, the decision for these two alternatives would be to go for alternative B. That means, you will choose that equipment which has little higher initial investment, but subsequent lesser amount of annual expenses. So, just to summarize this method of analysis, what you do? Step 1, draw the cash flow diagrams of both the alternatives. Step 1 would be draw the cash flow diagrams of both the options. Step 2, calculate the net present worth or the total present worth in case revenue dominated cash flow diagram is there. Calculate the present cost in case cost dominated diagrams are there, or in case there is a mixed cash flow diagram, calculate the NPV or net present value and then compare the two. If you find that one alternative has got the least cost, choose that option. If you find that some alternative is giving you maximum benefit, go for that option. If you find that net present worth is higher for a particular alternative, choose that alternative. So, this particular example showed you how to calculate the present cost as far as cost dominated cash flow diagrams are concerned. Now, we will take some other example, not this. Now, let us look at this particular problem. In this particular problem, it is given that an investor can make 3 end of year payments of rupees 7.5 lakhs. Just to remind you, 1 lakh is rupees 100,000. 1 lakh is rupees 100,000. Here in India, we are quite familiar with talking in terms of lakhs, whereas you may not be that conversant with this particular terminologies. So, that is why I am telling you, you please note it down somewhere, that 1 lakh is equivalent to 100,000. So, in this particular problem, it is given that an investor can make 3 end of year payments of rupees 7.5 lakhs, and these are expected to generate receipts of rupees 5 lakhs at the end of year 4, that will increase annually by rupees 1.25 lakhs for the following 4 years. If the investor can earn a rate of return of 10% on other 8-year investments, is this alternative attractive? So, here also if you notice carefully, there are 2 options given to an investor. Now, both these options have got 8 years life. In second case, the investor is making a return of 10% straight away. So, for the second alternative, you are just given an information that rate of return is more than 10%, or rather it is 10%. Now, for the first investment alternative, it says that 7.5 lakh you have to pay for how long? For 3 times. That means, you have to pay at the end of year 1, end of year 2 and end of year 3, and now this investment is going to give you rupees 5 lakh at the end of year 4, which is going to increase annually by rupees 1.25 lakhs. That means, at the end of year 5 you are going to earn 5.25 lakhs, at the end of year 6 you are going to earn 6.5 lakhs, at the end of year 7 you are going to earn 7.75 lakhs, and at the end of year 8 you are going to get rupees 9 lakhs. So, the cash flow diagram for alternative 1 or investment option 1 is shown like this. You can note down this. This is end of year 1, 2, 3. Here we are at time t is equal to 0. So, if you see it, it is something like this. At time t is equal to 0, nothing. Year 1, 2 and 3, you have to invest rupees 7,50,000 or 750,000, and this is going to give you rupees 500,000 here, which is going to increase every year by 125,000. So, this is end of year 4, end of year 5, 6, 7, and finally 8. So, it is something like this. First, at the end of year 4, I am getting a return of 500,000. Here I am getting 625,000. Here I am getting 750,000. So, what you find, every year it is increasing by 125,000. So, this is as far as alternative 1 is concerned. For alternative 2, you are given that it is giving you 10% return. So, when do you prefer alternative 1? If you find that if alternative 1 is going to give you more than 10%, alternative 1 would be preferable. Under what circumstances you will find that you should go for alternative 1? It is in those situations in which you find that rate of return is more than 10%. If you find that rate of return is less than 10% in alternative 1, then there is no point of going in for such kind of investment. So, what we need to do is, for alternative 1, I will assume a rate of interest of 10%. Why I have assumed like this? Because this return he is going to get from second investment option. Now, corresponding to this I is equal to 10%, I will find out the net present value for alternative 1. Now, if the net present value of alternative 1 is positive, that means greater than 0, at I is equal to 10%, that means this alternative is giving me more than 10%. Is it clear? What I will do is, if for this alternative 1, at I is equal to 10%, if net present value is greater than 0, it means I am getting a return more than 10%. So, all my interest factor computations would be at I is equal to 10%. Now, what I will do? I will compute the present worth of this investment 750,000 at time t is equal to 0. This I can write it in negative, because these are my expenditure, my investment. So, this money is going out of my pocket. So, this 750,000 for first 3 years, year 1, year 2 and year 3, I will convert it at time t is equal to 0. Using what formula? Using uniform series present worth factor. Why this? Because I am given A, I am interested in finding P. So, I will use P given A for a period 3 and for an interest rate 10%. So, I find out the value of P given A 10% for a period 3 and multiply it with 750,000. The value I write it in negative. Now, I will also calculate the present worth of these cash inflows. Understand inflows because these are on plus side. So, this is the return that I am getting after an investment of 750,000 for first 3 years. At the end of year 4, I am getting 500,000. End of year 5, I am getting 625,000. At the end of year 6, 750,000, and likewise for up to 8 years. So, how do I convert this? There are many ways. The simplest would be to bring each one of them. For example, this 500,000, what is it equivalent to at time t is equal to 0? So, this 500, or else you can use the arithmetic gradient conversion factor also to convert this portion, triangular portion, into a uniform cash flow. But for the time being, I am going to take each of these cash flows and bring it at time t is equal to 0. So, this 500,000 would be equivalent to 500,000 divided by 1.1 raised to power 4. Similarly, this 625,000 is going to be 625,000 divided by 1.1 raised to power 5. Now, this entire computations has been done and shown in this particular slide. If you see this particular slide, it very clearly shows net present worth is nothing but total benefits minus total cost, or rather total returns minus total cost. So, return we are getting from 4th year onwards. So, for 500,000 it is equivalent to 500,000 divided by 1 plus I raised to power 4 plus 625,000 divided by 1 plus I raised to power 5 plus 750,000 divided by 1 plus I raised to power 6. If you do not want to use these formulas, straight away you can refer to the interest factors table. And which factor you will be finding? You will find P given F at an interest rate of 10% for period 4, for period 5, for period 6, for period 7 and for period 8. Right? Then when it comes to total cost, you have to subtract it. So, 750,000 divided by 1 plus I raised to power 1, 7 and minus 750,000 divided by 1 plus I raised to power 2 and so on. So, you find that the net present worth is coming to be rupees 20 lakhs, or rather it is rupees 2 lakhs 3,320, which is positive, indicating that this investment option is giving a return of more than 10%, is giving a return of more than 10%, because if you remember, the total return computations were performed at I is equal to 10, at I is equal to 10%. Okay. So, this is as far as our discussion on present worth computations for alternatives involving equal lives were concerned. In next class, I will illustrate you how to calculate present worth when the lives of the alternatives that you are considering vary. For example, in one case for a given alternative the life could be 4 years, for another alternative the life could be 3 years. So, when you have such type of situations for your problem, there are two approaches. One is called common multiple method and then another method is called study period method. This as well as a third type which is dealing with infinite life situation will be dealt in lecture number 9 of ETC 779. So, with this I close this lecture and I invite you for any of your queries. Thank you. ये कनेक्ट क्यों नहीं कर रहे हैं उधर? Is technology class? Yes, MOE. Can you connect to the classroom, please?
No, that was no question. Thank you.
ये करते क्या है?